All right, welcome back to the TD Ameritrade Network. It's time for the closers panel. We got a great one with us here today. Larry Shover is the CIO of Efficient Advisors, a regular here on the network. Larry, awesome to have you in for the panel.
Thank you. Great to be here once again.
You got it. And Scott Connor, the host of Virtual Trade, with us, as well as the Managing Director of Futures and Forex, JB McKenzie. So, Larry, one of the things I think is interesting today about this market is you've got a little bit of action bonds, not much though, a little bit of climbing yields after the tariff stuff this morning, but the stock market is almost like thinking more about interest rates than bonds maybe are. You've got financials up throughout the session, and then utilities on the other end. What does the tariff situation mean, do you think, for fixed income?
Well, right now it means nothing. I mean, the response has been muted.
Kind of meh.
Right? I mean, we saw a little bit of curve flattening on a 210, which shouldn't be surprising. But I think overall, I mean, notice there was no formal press conference from the president about this, and there was no date set for the next one. So I think the fixed income market just in a hold and wait pattern until we hear from Powell, which is coming up in the next 24 hours.
Yeah, so we're going to get Powell, and we know that his bar is pretty high now for keeping markets happy. Scott, should we expect to get some reiteration of dovishness, or what? Let me ask it this way, because we don't know what Powell's, we can't get in his brain. But instead of playing psychology, let's think about what the market has to respond to, which is there a risk of a sort of retooling of how the market thinks about Powell if he doesn't he just feels like he's got to keep nailing the exact same lines over and over again.
And if he doesn't, it feels like the market wants to drift higher, or rates want to drift higher.
Right.
And that's what I think we've been seeing last week and this week. And I think you just hit on something I think really important for people who are watching the markets today. Why were they in the top 3 best sectors today and utilities were last?
Right. That to me seems like they're thinking interest rates, right?
Exactly. If you follow sectors, that's a reflection of people anticipating higher rates. Even though we haven't heard what Powell's going to say yet, it kind of seems like the market is getting ready or setting up for him to be slightly more bearish, if you will, hawkish, I think in this term is the correct term, than maybe the market was discounting up to this point.
Larry, what kind of stuff, because I know you're a big bond guy, what kind of stuff are you looking at to see if there are kind of like the winds of change coming for bonds directionally? I mean, is it looking at auctions to see how they're received? We had a 5-year and a 2-year today. Is it looking at how the market responds to macro stuff? Positioning, what tools do you use to try and gauge that?
Yeah, and it's so hard to answer because, you'd think it would be just data, it would just be supply, but I think it's everything. I mean, you consider the stock market's up, 11 or 12% from its low, and 10 years have moved, 15 basis points? So just like I was saying on Friday, I think I'm watching something that's going to be outside of the Fed. I mean, unless Powell makes another abrupt.
And I thought you made a good point here, because I think it's a fairly nuanced point. It's that, look, this may not come internally.
Right, and I think I still maintain that. I mean, I believe it could happen organically, but that would be a real key test for the stock market. But I think, overall, it's going to be something that comes from outside of the United States.
Yeah. Well, maybe one of the overlooked pieces today of the puzzle maybe was this Dallas Fed number on the manufacturing side. This is a pretty massive beat. It was at 13 compared to the 4.8 consensus. A tiny bit of relief, I guess, for those that have been concerned since the retail sales, since the Philly number last week. JB, we still see that industrials are the best off the low. GE added it to a little bit today, so the stock market seems to be pretty okay with the economic situation.
Yeah, I don't think there's that much disappointment. I think that retail sales number was one that was a disappointing number, and you've seen sort of the market continue to adjust for it. But you kind of are having all these little beats that happen along the way. They're not big numbers that are coming through. The Dallas manufacturing number is not an enormous number that's watched by everybody, but it's another important, I think, victory sort of to prove that the economy is chugging along. I think you couple that with the dollar coming off a little bit here today as well.
Finally.
A nice little pressure coming off. That's 2 days in a row, and now you're back up there testing. Are we going to get above 28 to close the session, 2,800 in the SPOOs? I mean, that's a big question. If we get above that mental note, then you could see a little bit more momentum continue on for the rest of the week.
Yeah. Scott, let's talk.
Say, it's, in observing today, it's a very conflicting day. I think the market really kind of struggled to figure out, okay, is the news bullish, bearish, what's going on here? Because if you look at, obviously, what happened in China overnight, those were huge numbers. I mean, the Shanghai was up 5.5%. I mean, that sets the table for the U.S. to be up huge today, but we weren't, right? And we had VIX higher. and we had oil down, which is, we've had this huge correlation with the markets and oil, but oil went the opposite way today.
Yeah.
So I think that's one of the reasons we saw VIX go up, because yes, the news in China was great, but there were some other things that people were a little bit more worried about, like some of the decoupling of oil and higher interest rates. And we think, wait a minute, great news from China, but we have a couple other negatives here that if we had no news from China, we might have been looking at a pretty solid down day.
A Trump tweet just kind of killed oil for the day.
No,
basically.
And by the way, he's done this before. Right?
Right.
This is the exact. I mean, I don't know if he copied and pasted the same tweet from a couple of months ago, but
worked.
basically the exact same thing came out, right? Where he said, "Look, I disagree with these prices. This is ridiculous." And by the way, again, that's a very strong relationship. Saudi Arabia and the U.S. is a very strong relationship. So if that starts to get going to that same thing, where that could start to have a pressure, now all of a sudden you got crude coming off 3.34%. That's a nice little pop, and it's had relief.
Yeah.
When there is no actual news associated with productivity, this is purely about prices and, hey, don't do what you think you're doing.
Yeah, and keep in mind, oil was higher. I mean, slightly higher, like probably by the time I woke up, and it was just a tweet. I mean, also the news that came out that Russia produced more than they talked about this month, so it doesn't take much.
One thing's for sure, it was a very engaging day by the president on financial Twitter. He hit crude, he hit stocks twice. We got to get the guy on the platform. Larry, the other thing I'm thinking about is just looking at your notes from the S&P 500, which is, it seems like and this is again totally qualitative in my assessment of the folks we talked to, but it's either the market has to chug higher to highs or the market needs to go back and retest the lows. Your point is, well, why don't we just kind of grind here for a little bit?
Yeah, I think that's the best case scenario. The easy money has already been made, and I think right now it's momentum that's the tailwind. And momentum, we all know.
Right.
We've all traded, we know it. Momentum can carry a market for a very long time, but right now it's like momentum until we get data, a confirmation of data that actually, gives us the right for the market to go higher. Put it that way.
I think the other thing here, sector-wise, that's interesting is you kind of get a taste of what happens if some of the very, very pure kind of dovish plays don't work out perfectly. The one we talk about is, okay, well, maybe bonds have to recalibrate, but don't forget there's a whole other part of the stock market that, if this is a response to a tiny move up in the 10-year yield, what happens to utilities if all of a sudden we're inching back towards 3%?
Right. Oh, yeah. Well, I think that's one of the reasons people are watching Powell so carefully this week, and why that might be the biggest number that we focus in on this week. Because if we do get a surprise on that hawkish side, that could be the type of thing that turns this V-shaped recovery into, like Larry said, maybe we're consolidating now, but maybe we actually start to drop off a tad. Because everything else looks like it's pretty solid. And again, don't forget, we're just finishing. We're 90% through the earnings for this quarter. This is obviously the 5th quarter in a row of double-digit gains, and everyone's expecting the first quarter of next year, or 2019, to be a negative return. So, I think people are anticipating earnings dropping off, so we're not going to get much support there. So they're really going to be focusing on, okay, really, what is the Fed going to be doing from here on, and what's going to be happening to oil?
It's basically a pure multiple expansion story off the lows, Larry. Would you agree with that, or do you think there's been, because when I look at guidance coming down for earnings, and the way the market has responded, it seems to kind of scream dovish Powell's driving us, I think, 2017. I think coming out of the market route in 2016 as well. Which, does that type of mentality make as much sense today, do you think?
Well, at this point, what are we trading at? 16.2 times multiple, something along those lines? And that's not cheap anymore. I mean, I wouldn't say it's terribly expensive, but definitely is on the high side. So that said, much easier to buy the S&P 500 when we were trading at 15 times, and now going forward, we need something more. We need something more than just our past earnings season